It's only a month. But it is interesting how you get these counterintuitive results sometimes.
Steve and Joe, last year, 2024, it seemed to be the year for growth stocks, especially large cap growth. People were chasing AI. Now then, just barely into 2025, seems like things are turning around. Maybe a rotation out of growth. But, Joe, you were talking this morning with us. There's already been some surprising things that have happened in the first month of the new year.
Yeah, I think if you asked people about this, I don't think most people would get this. I don't think people think that things have really changed all that much. And look, I would just say it's 1 month, so it doesn't really mean all that much. It's only a month. But it is interesting how you get these counterintuitive results sometimes. So when we look at year to date, I mean, like I said, it's only a little over a month. But here, I think with all the talk, well, here's the most surprising result to me. The dollar has been strong and has gone up since the election. I don't know, 6%, whatever the number is. And yet, the best performing asset this year is gold, up over 7%. And we normally see gold perform well when the dollar is going down, not when the dollar is going up. By the way, we also normally see gold performing well when the economy is bad, when interest rates are going down. And that's not the case either. Interest rates are up. And it's just odd to me that that's where we are and that's what we're getting. And even if we go and look, let's just take a look here and see what it looks like if we go back to the election on November 5th. From there, from November 5th, you do see growth stocks outperform, but even there, gold is up over almost 3%. And commodities are up over 5% during that just since the election. And so I don't know. It's very interesting to me how we've gotten these results. But this year so far, gold up 7%. And I think really, really surprising. All this talk about tariffs and European stocks are outperforming US stocks. European stocks are up over 5%. I mean, who would guess that? If you look broader, even broader on the EFA index, which is Europe, Australasia, Far East, is kind of an international index, up 3.6 versus a 0.86 for the Russell 1000 Growth Index or 1.76 for the S&P 500 Growth Index. Total international, the Vanguard version's up two and change, still better than growth stocks. I just find that stuff fascinating. Look, we've said for a long time, that value is going to start to outperform, and I think it will eventually. If you look at history, history says value and growth get you just about the same place. Growth involves a little bit more volatility, but if you look over the really long stretch of history, value stocks and growth stocks perform about the same, with value with a slight advantage. It's not that big of an advantage, and it's actually not that big of an advantage just simply because growth has outperformed so strongly over the last decade. Prior to that, value had outperformed. So I don't know if this is the beginning of that. It could be. And I would say too that if we do get some type of industrial renaissance, if you want to put it that way, from President Trump's policies, which I will tell you now I'm skeptical of. I think reshoring, onshoring, reshoring, whatever you want to call it, manufacturing in this country is going to be very difficult. Very difficult to do without big price increases, put it that way. I think about it and it's like, well, we were big in manufacturing in the 1940s, 50s, and so on. Even going back to the kind of the Gilded Age in the late 1800s, manufacturing was a huge part of the economy, not as big as farming back then, because farming was the biggest thing. But, you know, it occurs to me that manufacturing and that type of activity is more typical of emerging markets. And I wonder if maybe we just can't go back there. Maybe we just need to be focusing on what we're doing best right now, which is more in service and more in design and things like that. Technology. Maybe we don't need to be going back and becoming a manufacturing economy again. It seems like it might be a step backwards. I'm not sure. But anyway, that's neither here nor there. If you do get a revival of industrial production, then you should expect to see value stocks outperform because that's what a lot of the value stocks are. They're in that space. So maybe that's why things are starting to move in that direction. I'm not sure. I hope that if that is why things are moving in that direction, that it's going to be real. I would hate to see people kind of get out over the ski tips there and go, uh-oh, that didn't work. We'll see. Like I said, it is very surprising though, I think so far. We'll see how this goes over the next over the first quarter maybe and just see what happens. And everything could be upset on March 1st now, since we have now a new deadline for tariffs. Or maybe we get some, maybe Europe's about to get smacked. We've heard President Trump talk about that the EU is going to get tariffs too. So maybe that outperformance by Europe isn't going to last. I don't know. And that's the nature of the economy and the markets that we're in right now. Everything is so unpredictable and so subject to change, put it that way. So I don't know. Well, it's an interesting result so far. We'll see if it lasts more than a month.
Steve, it just seems like we've been looking at the backside of growth for a long time. It's always been out there in front of everybody on the racetrack. Do you feel like it's time for a change? It's time for rotation back into other things?
I really have no clue. Listen, you can very easily make a fundamental argument here that the way things are all lined up, you actually should get outperformance out of value, out of small, out of mid, and it's I don't even think you need like the reshoring to work out. I think you just simply look at the valuations, you look at some of the fundamentals, you look at earnings growth, and that tells you that in a rational world that we don't exist in, things look pretty good for small and mid and other sectors as well as foreign. Something we know long term is mean reversion works. Kind of Joe kind of brought up that growth and value performance is very similar, a little bit of an edge to value, but when you look at this stuff, you see over time. It's actually pretty efficient, but short periods of time when you're talking months or a year, you start feeling like you need more of a psychology degree than a business, finance, or economics degree. Uh, the large growth has been working so long that it really has to a degree gotten detached from fundamentals. I can't help but think like, the whole dot-com boom when you started looking at some ridiculous valuations. Well, they were ridiculous in 98. They were ridiculous in 99. So I really don't know. I kind of think it would be best if we started seeing fundamentals reassert themselves. I think you can make an argument that with a more real cost of money, um, that those fundamentals start mattering more than you're running such cheap money as you were in kind of that post '08 period. Uh, but I think we're going to find out. I think the next several months are going to be interesting to see if you do see a leadership transition. A lot of times, the leaders in a market stay a leader for the whole market cycle. But from an investing perspective, I think there's just a much more compelling investing case in these other sectors that have started showing some outperformance. So I'd like to think that the good investments are over the next few months going to perform better. And we'll see. That's kind of all we can do is observe and see. And it's interesting that we seem at the beginning of the year to be having a transition. But I would say from an investing perspective, from a long-term investing perspective, I think it's a pretty easy decision to be diversified and be in some of these other sectors and not have such a big bet on large cap growth.
Well, both of you have mentioned short term, and Joe, you said, will this apparent rotation last? Because it's just been a month. It seems to prove the case for our philosophy that we can't predict the future. We can only interpret the present, and even that's difficult.
Yeah, that's absolutely true. Look, as Steve said, some of the stuff in the growth sector is this growth space is just obscene. I'm looking at an AI stock right now, in fact, that is trading today up 23.75% and is now trading at its market cap is 100 times revenue, which is look, it's fast growing company, no doubt about it, growing at 25-30%. Is it worth 100 times revenue? That seems a little outrageous to me. We don't even want to talk about what it is as a multiple of earnings because it's a lot more than that. It's about 500 times earnings. And this is a well-known stock. I'm not going to even say what it is. but it is in the artificial intelligence space, and it's well known. And everybody wants to own it. And it's just kind of crazy. I don't know what the outcome of some of this stuff is going to be. Obviously, nobody does with, like you said, we can't predict the future. I don't know what the outcome is going to be from artificial intelligence. But I think at this point, some of these stocks are priced at levels and multiples that I don't know require that artificial intelligence does everything. I'm not sure what it implies, other than that maybe some people have lost their minds. Look, we don't try to predict the future. We do invest, as Steve said, we diversify. I can't tell you whether growth or value is going to outperform. I can't tell you whether gold is going to outperform. I can't tell you any of those things in advance. I can tell you what the probabilities are. I can tell you that if, for instance, the dollar is rising, then in general, we don't expect gold to perform that well. Does it work all the time? Apparently not. It didn't work last year. But that's not the way this works. You can't just go back to history and say, well, every time this happens, this happens. It doesn't work that way. And I can't tell you exactly why. These things are not mechanical. They're based on human emotions. Markets move on humans. Markets are nothing more than a collection of humans, and they move on emotion. So, what is gold rising as much as it has over the last few years? What does that mean? Well, to me, it means people are fearful. What are they fearful of? I'm not sure exactly. I'm not sure. It seems to be a fear of a financial fear, put it that way. But I don't know. I don't know. I can't get inside the head of all these other people out there and why they're buying these things and why they're doing what they're doing. But that's why we diversify. We own gold. It's part of our portfolio. It's helped us make some returns, no doubt. Which, by the way, it's the way this is supposed to work, right? Last year, gold produced a great return last year. Let's just see, what was that last year? I believe it outperformed stocks, the S&P 500. I could be wrong, but I don't think so. Let's just get a total return here on stocks and gold for last year. Let's see here. S&P 500 over the last year. If we go year over year right now, gold or S&P 500 is up 22.5% over the last year. Sounds great. And gold's up 38. If we go to last year and just say last year, we could do that too, but it outperformed last year too. And let me just go to the end of 2024 here, and we'll get this number up. And last year you had, 26.85% for gold and 24.89 for S&P. So what did it do for us? Well, we own gold, but we also own more value-oriented stocks. Stock portion of our portfolio underperformed, but we made up for that, or at least part of that, by owning gold. It's not correlated with stocks in general. It was correlated last year, but that's not the way it normally works. And commodities have done pretty well this year too. Same thing. That makes up for if you have a stock portion, if you own something in your diversified portfolio that doesn't do well, something else picks up the slack. That's the way this is supposed to work. And theoretically, you get a better result that way. You get a better return, or at least an equivalent return, and you get lower volatility. That's what everybody wants. They want to get a better return with lower risk. So that's what a multi-asset class portfolio is designed to provide. It's designed to be less volatile, more consistent, and provide you with a return that allows you to reach your goal. That's what we try to do. I try not to worry too much about things like, oh, did we keep up with the S&P 500, or did we keep up with some 60/40 portfolio? It's not really the goal here. People have these false ideas. You don't need to keep up with your neighbor. If your neighbor bought some AI stock and has made a fortune, you don't have to try to chase that now. He's him and you're you. He has goals, you have goals. They're not the same. And so I concentrate on, are we meeting the client's goals? Do you have goals to meet? Can we produce a return with the portfolio that we have that will allow you to do that? And that's really what we focus on. And that's what everybody ought to be focused on. If you start focusing on something else, start focusing on the result, you're going to make a mistake. If you start worrying about the result, concentrate on the process. The process is how you build a portfolio. And a diversified portfolio will get you where you want to go.
So we just want to mention that if you're frustrated with the markets and don't really know what to do, we'd love to have a conversation with you about how we can help. If you'd like to have that conversation, email us at info@alhambrapartners.com.